Hello and welcome to another episode of the Real Estate Investing Club, the place investors go to learn tips, tricks, and stories from other investors in the field. Before I introduce today's guest, I have three short housekeeping items to cover. First, if you like our content, the best way to support us is simply to like, subscribe, comment, or share this episode with your friends and family. Second, we are active investors ourselves and are always on the lookout for mobile home, RV, mixed-use commercial, and multifamily properties in MSAs with a population of 100,000 or more. So if you are also an active investor and have something you think we may be interested in, we would love to take a look. Send us the details of the deal at www.therealestateinvestingclub.com. Third, if you are a new investor and would like to learn how to get started or scale your real estate investing business, go to www.therealestateinvestingclub.com to check out our course. So without further ado, let's dive right in. We have a very special guest with us today, so buckle up, grab your pen and paper, and enjoy the ride.
All right, we are live. Today we have Max Sharkansky from the managing partner at Trion Properties. Max, thank you for joining us. How are you doing today?
I'm doing great. Thank you for having me. How are you doing?
I'm doing fantastic. To get us started, why don't you tell everybody, who you are, where you're from, and how you got started in real estate in the first place?
Sure. My name is Max Sharkansky. I'm the managing partner and co-founder of Trion Properties. We started out back in 05-06. Prior to that, I was a broker at Marcus & Millichap, selling apartment buildings in the San Fernando Valley. So naturally, my partner and I started buying apartment buildings in the San Fernando Valley. Our strategy was then what it is now, just on a much smaller scale. We were buying value-add multifamily real estate throughout the valley. Bought a little 12-unit. That was our first property. Then a 34-unit, and then we bought our first two at the end of 05. We continued buying into 06. Then it just snowballed, and we said, hey, this is what we've always wanted to do full time. He was on the debt side. My partner, Mitch Paskover, worked at HFF, which has recently been acquired by JLL. And he was on the debt side, and we said, hey, this is where we want to be, so let's keep it rolling. We aggregated a small portfolio in the last cycle. We had fortunate timing, and we sold most of it in 2008 prior to the crash.
Oh, wow. Nice.
Thank you.
Just by the hair of the skin of your teeth there.
By the skin of our teeth. One of my friends who I used to work with at Marcus said it was like Indiana Jones sliding underneath the wall. You guys did.
Very good.
So as we were selling, we changed our strategy from value-add multifamily to buying non-performing debt secured by multifamily, as well as trying to get REOs. But that came a year or two after that. So we started that in 08. There was such a huge bid-ask spread in the market because that was during the first wave of defaults. It really hadn't crashed yet. So, we were calling banks, offering like 60 cents for notes. Asset managers who were also kind of like loan originators were saying, pound sand, this property, the note's worth 98 cents or whatever. There's not that much loss. And we said, okay. So it took us about a year and a half for our first closing. We bought our first few notes from East West Bank. And then from there, that snowballed. And we had a very successful downturn, actually, in 9, 10, 11, 12. We bought about 20 deals, about 15 of which were non-performing notes, and about 5 which were REOs. And we would go all the way through the cycle of the actual foreclosure. So we would buy the note, foreclose, renovate, because we had our own crew. So we would renovate, do the lease up, and then sell it once the value was maximized. So we were actually.
So you did sell. You didn't refinance.
No, unfortunately, which is, I know it sounds crazy looking back on it. So believe it or not, we were looking at metrics in South LA where we would solve to like a 13 or 14 cap and sell it like a 9 cap or an 8.5 cap.
Not bad.
Yeah. That's how it looked back then. It was so bad. So Then coming out of it, once the market cleared, we just went back to the value add business. on a larger and larger scale. And we grew out of our own, and we grew geographically as well. We grew out of our own city. At the time, it was just LA. And during the downturn, we kind of went wherever the distress took us. So we went up in Sacramento and Fresno and Eastern San Diego. And once you crack that seal of being out of your own backyard, you become fearless and you're willing to go to more places. So we're now San Diego, LA, Bay Area, Portland, Oregon. We're closing on our first deal next month in Denver, Colorado.
Oh, nice.
And we're also looking at opening an office now in the Southeast and expanding into Florida, Georgia, and the Carolinas.
Wow, that is awesome. Well, first, congratulations. It sounds like you guys have had great success. So, congrats on that.
Thank you.
So I'm gonna try to summarize everything. It sounds like you've had a really wide career, and so I'm gonna try to summarize everything you just said there. So you started Marcus Millichap as a broker, and
right.
You were as the broker, you were kind of seeing these deals come across your desk. You decided to jump in 2006 to do your own flips for multifamily value add. You did that up until 2008, right before the crash, just got out. And then you switched over to non-performing debt notes from 2008 to 2012, where you did about 20 deals in non-performing notes and REO. And since 2012, it sounds like you've been focused on value add multifamily. Multifamily only, or do you do mixed use commercial or anything? Single family?
We're multifamily operators. We're fully vertically integrated. We do management in-house, software is in-house, project management is in-house. We have our own crew. So we're very built out for multifamily. We're true multifamily operators. We bought a little bit of retail at the very end of the downturn because multifamily was the first asset class to clear. There wasn't anything by early to middle 2012, there wasn't much left to buy. And my partner and I said, hey, we've done so well on this stuff. Let's try to buy some more, but we can't buy any more notes on apartments or REOs. So what else do we understand? So we bought some retail, but that was like a 1 to 2 year run, call it a 2-year run. And we stopped after 2 years. Gotcha.
Okay. So multifamily is really, that's your wheelhouse. That's where you guys are kind of focusing your energy.
Correct.
Awesome. So I want to jump in. I mean, multifamily is, as I said, it's your wheelhouse. So I want to jump into that. But before we do, I haven't had a lot of people on who have talked about investing in notes. And I am personally interested in that because I've never done it. And it's, a new thing for me. And I'm sure other people listening and watching are also, interested in how that works. So in 2008, you were investing in non-performing debt. So kind of tell us how that works. How does it differ from going on the MLS, finding a multifamily property, putting in an offer, all that stuff. So what does the process look like for investing in notes, non-performing notes?
So that's a good question. Those days were the wild, wild west, right? It is the antithesis of going online onto LoopNet or the MLS and trying to find something. It's highly opaque. Although you did have auction.com, but those were priced through the roof because it was transparent.
Yeah.
And everybody had access. So the way we were doing it is we would call asset managers directly. So we'd call the banks. That was probably how we got maybe 20 to 30% of our notes. The balance of it was calling the brokerage community and just calling everyone and saying, hey, here's what we're doing. We're closing. We're performing. There's not a lot of groups out there who are doing it. And by the way, we can pay more than your other buyers because we actually have our own crew in-house. We're operators. Whereas our competitors were like ex-finance guys where it was like a one-man show sitting in an office, buy the note, foreclose and flip. We could pay a little bit more for the note because we would buy, foreclose, renovate, do the lease up, manage it, and then sell it. So
Gotcha.
We were highly competitive. And all the brokers who were actually working on it, who were smart enough to make that pivot, brought us tons of notes. We were like the note buyers in town.
I love it.
And
so
the metrics, it was such a bloodbath. A property that had sold, let's say, for example, for $10 million pre-crash, right? Let's say the debt on it was 7. The property is now worth 6.5 and they're in default. So we would buy the note for 5, do what we need to do, and then sell it for maybe 7.5 post renovation and stabilization.
Wow.
I mean, it was an absolute bloodbath. And we would then go to hard money lenders. So we weren't paying cash for the notes.
Okay.
We would that's one other way we were able to pay a little bit more. We would lever up our acquisition of the debt. So we would there were a few hard money lenders who would finance note purchases.
Wow, in the millions. That's impressive.
Oh yeah. So if we were buying a note for $5 million, we would only put down $1.5 to $2 million.
Huh.
So
Wow.
you're putting debt on debt, and then when you foreclose, the debt that you take automatically becomes a first trust deed.
Gotcha. Okay. So to find these, obviously, back in the day, 2008, there wasn't, actually, I don't even know if there is today. Is there a Zillow and MLS for notes, or just some kind of repository that you can kind of go to and view, non-performing notes?
Back then it was auction.com.
Uh-huh.
They were the MLS for non-performing notes. I don't know if they still do it because they're just few and far between, right? There'll probably be some in the next year on retail and hospitality and some office and things like that. Definitely not apartments. Actually, maybe just like the worst of the worst quality.
Yeah.
Will start to default. But for the most part, it's going to be on hospitality and retail. And I think you'll start to see that in the next year. Auction.com is on the forefront. I think now they're called 10X. There were a few other smaller ones. Mission Capital used to do it pretty well. They're out of New York.
Okay.
First Financial Network used to do some of it. So those are some of the groups that do it.
Cool. Okay. So 2008, you weren't doing any of that. You guys were actually calling the banks and the brokers, the people who own the debt, and you were saying, hey, we can buy this property. We've done it before. We have this process. We have a whole team in-house. We can buy it for more than other people because of that. And you just did that. You called around to actual people and got the notes that way.
Correct. And we would track the foreclosures on, I don't even remember the sites. I think there was actually a foreclosure.com. There are sites you can use because in California, it's all public information, right?
Mm-hmm.
As soon as a lender files a notice of default, it's recorded, it's public.
Yep.
And you could track that. So you could call them as soon as you see it hit.
Oh, wow. You mean, oh, gotcha. So you would see the notification and then you call the listing broker, or I guess it's not a listing broker.
No, not the listing broker. You call the asset manager, you call the bank.
Yeah. Okay. And then just say,
because
hey.
My partner, Mitch, was at HFF on the debt side. He knew some people, everybody at the banks.
Gotcha.
And people who used to be originators became asset managers.
Nice. So, it's kind of a theme that comes through this podcast is that everybody says real estate is so relationship based, and I 100% agree. But it sounds like if you want to get into the note space, it's even more so than in regular REIT or commercial multifamily or single family investing. Sounds like you really do have to know. You have to know somebody in the industry in order for it to work out for you, or you need to make those relationships work.
I mean, look, that always helps, right?
Yep.
It always helps to know a few people, but to be honest, a lot of the times we just called our way in. I just looked at who the lender was. I made a few phone calls. Oftentimes the phone number was right there on the default notice.
Yep.
You would actually have to call the trustee because the trustee files a default, right? And you say, and now you just ask them, who do I call?
Huh.
And oftentimes they just tell you, yeah, here, call this guy. He's the asset manager at XYZ Bank, and they'll help you out. So you just got to dial. You just have to be smart about it.
That's crazy. That is the Wild West.
It was the Wild Wild West.
Awesome. Well, that's super interesting. I'd love to jump in more, but I want to focus more on what you guys are good at today, what you really enjoy talking about. So let's hop over to multifamily.
Sure.
I got distracted by your desk. It was slowly going down.
Yeah.
So you guys are doing multifamily now. You're doing value add multifamily, and you do everything in house. You have your team in house. You're flipping your contractors in house, and you guys buy and rehab. And do you hold them now, or are you still selling them off?
It's a combination of the two. I mean, we usually underwrite everything to a 3 to 5 year hold. Our plan going into 2020 was to do a recap on about 40% of our portfolio, half of our portfolio. So some of the properties that have already been renovated or some of the properties that have been substantially renovated, we were going to put those together in a portfolio and go to like an E-Still or a JLL or HFF or whatever they are now, and take it out to market and take the original investors out, because we promised them a 3 to 5 year hold, and bring in like, opportunist capital, but institutional capital is what I meant. Bring in institutional capital who's a little bit more lower yielding and wants to hold 8 to 10 years.
Okay.
On the assets that we want to hold. Right.
Gotcha.
So, I guess as a rule of thumb, to answer your question, well, maybe hold half and sell half.
Okay.
We still have to sell some to make ends meet.
Yeah, and
overhead and
to get the down payments down and all that stuff. Awesome. So I kind of want to go to the every deal is a process, and it all starts with finding that deal. You already kind of went over the note side of things. You guys were just you're hitting the phones, you're doing cold calling, and that's how you kind of got those leads to come your way. So how is it on the multifamily side? How do you guys go about finding these distressed properties that are out there in California?
Primarily, we do it through the brokerage community. They know us. We're active in all of our markets. We perform. We'll put some hard money up day one. We'll do a lot of DD up front. I remember when I was a broker, what I like to see in a buyer. So we just try to behave in that way. We're very easy to work with, and we perform. So
gotcha.
That's really the angle.
I like that you said that. So for everybody who is listening and watching, if they want to, if they really want to make a name for themselves in their specific market within the brokerage community, what is it that brokers are looking for? You mentioned a few things. You said that they want to know that you're going to perform. What other things is a broker looking for in a buyer? And how do you develop those relationships and show them that you have those qualities?
Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast.
They're going to want to probably see track record. What's your experience? Do you know how to buy? Do you know the area? Do you understand the asset? If it's a pretty heavy value add and the property hasn't been touched in 10, 15 plus years, they want to make sure that you understand that. They want to make sure you understand how to get through the due diligence process on something like that. Write super clean offers, shorten up your DD timeline. No loan contingency, put some hard money up either day one or when you go hard after your DD, maybe you pass it through. Just try to be as strong as possible.
Gotcha. Okay. So you mentioned due diligence. So let's go to your buying criteria and talk a little bit about that. So once you find these properties, how do you identify things that are actually properties that you're going to be pulling the trigger on? Like what criteria do you use to identify the opportunity, and then what is your due diligence process? How do you go about underwriting these properties?
I mean, we use a pretty complicated spreadsheet. It's like a 15 tab Excel spreadsheet
Love
with
it.
5 to 10 year cash flow runs, IRR runs.
Okay.
But if I had to boil it down to just a few, I mean, look, it's ultimately going to come down to what the IRR is, right? That's what the investors want to see. They want to see, what am I going to make on my money, and what's my multiple, what's my IRR, what's the cash flow going to be? But that's a result, right? So if I had to figure out what the most important pieces along the way are to get that result, the first thing I always ask is, what's the return on cost? Meaning, what is my cap rate after all of our improvements and all our cash into the deal? Cap rate, what's our NOI divided by total capitalization on the deal?
Gotcha. Yep.
And I know that there's enough spread between my return on cost and my exit cap. Everything else will work itself out.
Gotcha. So, we're heavily involved in mobile homes and RV parks right now, and those usually trade at a pretty high cap rate. So for multifamily, what kind of cap rate are you guys looking to buy at, and then what cap rate are you looking to sell at in the 4-year exit?
We're in California. Okay, so this is artificially, however you want
It's
to
an
call
odd
it.
market.
Yeah. We're in a very low yielding market. It's also had a tremendous amount of growth over the years, and a lot of people just don't increase rents. So what the difference you'll see in California versus some other states is you'll see a lot more upside. So
Interesting.
yeah, in California, you can oftentimes find stuff that's got like 30 to 40% upside or more versus some other states where it's usually like 15 to 20%.
Huh.
Because of the amount of rent growth that California has had.
Right.
So because of that, we're typically going in at a lower cap rate, which doesn't really scare us.
Okay.
So like we've bought stuff at 2.5 caps, 3 caps, 3.5 caps. It doesn't really matter.
Gotcha.
Because our sole focus, I mean, look, it does matter, of course, with the debt when you're looking at all that stuff and the interest reserves, but it really comes down to what's the return on cost. So we're usually, in our markets, on average, we're usually solving to like a mid 5 cap, 565 cap, somewhere in there. And that's untrended, right? So on a 3-year hold, 4-year hold, we're getting to like a 6.1. And then we can exit at like a 4.8, 5.
Wow, that's pretty low.
Yeah,
that's California for you.
But when when you're selling, when you're working in these low yields, 100 basis points is plenty.
Yeah, absolutely. Especially with at such a high purchase price and sale price, I'm sure it actually works out in the end. So we try to keep these episodes around 20 minutes. So we are coming in on the end of the episode. So I'm going to switch gears just a little bit. We've talked about your multifamily business. We've talked about the notes. I want to go on to a few of the stories that you've had. I mean, you've been in real estate since 2005, 2006. I'm sure you've seen pretty much everything there is to see at this point. So, we all know real estate's a roller coaster. You got your ups, you got your downs. So take us to one of the crazy down periods that you had. And what was the story that you pulled out of that, or the lesson that you pulled out of that?
I think I took you through a wild ride during the downturn.
Yeah.
And if there's one lesson I would give to everybody out there, it's real estate does not kill people, debt kills people. So if you have a low debt, low leverage, you will be fine going through a downturn. Right now, our portfolio is fine. We don't have, I think of the 20 assets right now we have in portfolio, we have one that's maybe just like an eyelash underwater on cash flow, but I mean, it's negligible, and we've got plenty of cash in the operating account, so I'm not even looking at it. So we're fine. I mean, we're positive cash flow right now, portfolio wide. And that's because we don't go into the whole like max leverage, 80%, squeeze every last dollar out of it. Just watch your debt levels. That's the one lesson I would give to everyone. Watch your debt levels.
I love it.
We've got properties right now. So, we're, call it, 94 to 95% occupied. Our collections right now are probably 95% of that. So, 90, then we've got, going into, through COVID, April, May, June, July, we've been leasing a lot with concessions. So, our economic occupancy right now is not fantastic. It's in the 80s, yet we're still cash flow positive.
Yep, because you don't have a high debt ceiling on your properties.
And I can sleep at night.
Yep, absolutely. So what, just kind of on that note, how much do you guys put down for properties when you buy them? Are you do you put 30%, 40%?
So that's a good question. Again, California, Oregon, markets that we're in, they're pretty low yielding markets. So we want to be very cognizant that once we do the renovation, we can refinance it and take it out, right? Yep. So we're typically going in high 60s loan to cost, right? Okay. So if we're buying something, let's say for $25 million, total capitalization is $30 million, we'll lever it to like 20, 21, 22. So we're like 67, 66%, somewhere in there.
Okay. And in that range, that's the safe zone. That's where you feel that, you can hit economic downturn can come and you guys you'll still be above water. You still be treading. You won't be sucked under at that point.
Yep. And then once we refinance it, after we execute on the business plan, we'll refi it. We're probably going to stay at the same levels, around 67, 68%. And one other thing I would highly advise is try to get interest-only debt.
Okay, interesting.
We're very big on interest-only debt. I mean, that's part of the reason we're predominantly interest-only. I'd say we're probably 65, 75% interest-only through our portfolio. And one of the reasons we don't have to worry about being underwater is because we're not paying down principal. So your DSCR on P&I, your lender is going to underwrite you to 125, 130, whatever it is, based on a principal and interest loan. But if you're actually getting interest only, you're not paying down principal, your actual DSCR is going to be 175 to 185.
Yep.
So you have a lot of cushion there for the market to go down.
Yep.
And rents to soften and vacancy to go up.
Absolutely. Yeah. We, whenever we negotiate with sellers, we always push for seller financing. That's one of our favorite things. It's how we're buying this park out in George. And, we always, push for interest only loans. In reality, in our opinion, it's best for all parties. They get more money. We sleep at night. So it's a win-win situation. So I would like to echo that one. It's a good strategy for sure.
Definitely.
All right. So, you guys have had great success. So, congratulations again. That doesn't come just by happenstance. You guys are doing things on the daily basis that is contributing to that success, the actual actions that you're taking. So kind of tell us and tell the listeners, what is the habit that you feel, or maybe two habits that you feel contribute the most to your success?
I would say just build a phenomenal team. We have a phenomenal team. I can't say enough good things about them. And they all work together in unison very, very well. We've got a fully transparent environment here. Everyone's working together. The acquisitions team, the project management team, the operations team, the accounting team, the admin team. Everybody just does a wonderful job. And they work together very, very well. And that's why we can execute the way we execute and make it look easy. I get a call from an investor saying, how's the project doing? I say it's on schedule and on budget. And it sounds easy. It's 4 words: on schedule, on budget, but it's years of practice, years of repetition, and it's everybody working together like an orchestra.
I love it. Build a team. That is really great advice. Especially, I like that you said the word transparent. That is definitely the best way to build a team is, transparency, being open and allowing everybody to say their words. So Max, thank you for coming on. I really appreciated you sharing everything that you've shared with me, and I'm sure everybody else has as well. Everybody that comes on, you've given us a lot, but if you could receive something, what would you actually want to receive?
What do you mean?
Deals, leads, Easter basket. A little
bit of everything. Deals. If if there are any brokers on the call or you're hearing this, listening to this, definitely bring us deals. We'll close very quickly and we'll make your life as easy as possible. for investors, you can log online, go to our website, trionproperties.com. We've got a whole education page that we build out for investors talking about basic real estate fundamentals. You can log in, create an account, and you'll see our deals. And feel free to invest.
Awesome. I love it. And that's the next thing I was going to say is if somebody did want to get in contact with you, what would the best way for them to do that?
Max at trionproperties.com, Trion Properties.
Perfect. There you heard it. Max at trionproperties.com. And I'll also put his LinkedIn profile in the show notes. So if you want to reach out to Max, check that out. Again, Max, thank you for coming on. For everybody listening and watching, thanks for joining the show. The best way to support us is just to subscribe, like, and share with your friends and family. And we look forward to having you guys on the next episode.
Great. Thanks a lot, Gabe. I appreciate you having me on.
Thank you for joining us on the Real Estate Investing Club. If you feel we provided value, we would appreciate it if you hit that thumbs up, share it with your friends online, whatever it may be. If you'd like to share or partner with us on an investment deal, we are always looking for quality projects. Go to www.therealestateinvestingclub.com to get in contact with one of our partners. Otherwise, I hope you guys have an absolutely fantastic day, and I look forward to seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.